You and I both know closing expenses generally comprise three things or four things: closing costs, prepaids, escrows, and HOA. That's generally what our closing expenses are going to make up, those four things. Not just closing costs. That might be the biggest chunk, but it's not just closing costs. But then you've got the other ones. Well, you add up all of those costs, and depending on the sales price, that may come to somewhere around 1.5% to maybe 3% of the purchase price. I always don't like to use percentages. I'd rather add it up. Use my cheat sheet. If one of you, Brett and Danielle, if you don't have the cheat sheet, you let me know, I'll send it to you, okay? I have a cheat sheet on closing expenses for you. You can use that. Now, but people are saying, Greg, why are lenders telling people that their closing expenses, and this is a discussion I had with Worrell and Cuggan last week, why are people telling them that their closing expenses are going to be $12,000, $13,000, $15,000 when we're estimating closing expenses at somewhere in the, depending on, again, the sales price, somewhere in the ballpark of maybe $7,500 to $10,000, but they're coming in at $13,000, $14,000, $15,000. And in almost every case, it's because of something called discount points. Now, some of you know what discount points are. Who does not know what discount points are? Anybody? Everybody knows what discount points are. Okay, discount points are coming into play today like they have since about August, when interest rates started reaching higher levels, which is where they're at today. And the reason for discount points is because the servicers, the end person who is going to be servicing your loan, when they establish pricing through Fannie Mae and Freddie Mac, but when they establish pricing, keep in mind they are expecting that that loan is going to stay on the books for some period of time. Generally speaking, a servicer is going to expect, excuse me, a loan to stay on the books somewhere between 3 to 7, 8 years, someplace in that window. So on average, whatever their average number is, that's what they're expecting a loan to stay in the books, because that's how they make money. You know, we all think that they make money by giving you and I an interest rate. No, the servicer, I make money by giving the interest rate because I get paid. Lenders get paid from whatever that servicer, whatever that pricing model says you're going to make. So we know we're going to get paid something. Okay, that's how it works. But the servicer, they're going to get paid over time. And generally speaking, they don't make a ton. They make maybe 25 basis points on the servicing of a loan, and that's it. It's not like it's a lot. So think about this. Interest rates have gone up considerably. And Jeff just made a comment a little bit ago, and I responded by saying, well, they're not going to be doing a lot of recasting right now because they're just going to refinance in a year anyway, because interest rates are so high. Now think about that from a business perspective. So if you are the business and you're expecting that you're going to sell something and that sale is going to produce income for, let's just say, 4 or 5 years, and you look at that sale and you say, you know what, that's not going to happen. They're going to dump this thing in a year. What are you probably, as a business person, going to do with the price on that item that you're selling? You think you're going to make money off of it for 4 years, but looking at it, that ain't going to happen. I'm probably only going to make money for a year. What are you probably going to do with that cost of that item? Back to the consumer. Jack it up a little bit. Well, that's all that's happening today. And so when you hear a lender say, I don't have a par rate. Par rate means no discount points to get that interest rate. That's what a par rate is. And I'm going to show you on the screen where a lot of loans today do not have a par rate. It's not there. There's discount points. That's why I went through this little explanation at the beginning so that you would have the opportunity to see why that's the case. It's simply just plain business mathematics. They don't want to give you a rate at 7.5 and no discount points, knowing you're just going to refinance it anyway in a year. So let's take a look at this, and I'm going to show you on the screen. So bear with, I got to open up my notes. I took some notes so that I would be able to do this more quickly without having to calculate things. So let's go into here. It'll take just a moment. Here we go. Good. So I'm going to start out with a loan of, this is going to be FHA to start with, $337,750. And I'm old, I got to wear glasses, I'm sorry. This is a sales price of $350,000. And it's 96.5%, so just 3.5% down payment. Nobody doing FHA loans has 36 months of reserves, so. And I was going to do 7 point, let's see. We're going to do 7, let's see, where's my FICO? 745. They're not self-employed. By the way, self-employed, regular employed does not make any difference in terms of pricing. So it's just a box we have to check. Let's go to 48%. Let's say that they are first-time home buyers. Again, that doesn't make any difference in terms of pricing, but it's a box that the lender has to check. Let's just say it's Bacon County. I don't know where that is. It's an FHA loan. And we're going to go to 7.25. Now, this is a live situation. This is live. This is what, if you asked me to plug this in, this is what I would be plugging in. And what I'm going to show you is where pricing's at on this particular scenario. So let's go straight to FHA. Let's open this up. And let's take a look. Okay, so what it shows you, you can see there's no par rate. Remember, par means interest rate with no discount points. That's what it means. Do you see? The highest interest rate we even offer right now is 7.25. And that's coming with discount points of $1,395. Now, does that mean the borrower has to pay that? Because the lender, thank you, Jeff, the lender can actually say, I could say, I'll go to my company and I'm going to ask them to pay to $1,395, okay? Some lenders will do that, some won't. Most lenders don't want to do that, comes out of their pocket, so they don't want to do it if they don't have to. It's like you discounting commission every time you do a loan, every time that you do a purchase. And I know some of you are saying, I think I have to do it every time anyway. Well, you know, when rates are this high, it comes in. But you can take a look at this and you can see that there's cost involved. And it's not every eighth. 6.5 is costing $4,378. That's what it costs to get that interest rate. That's what the lender has to pay. So generally speaking, that gets passed on to the buyer. Questions before I go on? All right, let's show you how this scenario changes. So if you'll remember $1,395, okay? So I'm going to change this a little bit. And instead of doing 745, let's do 785. And let's see if we can get out of paying discount points. Not 785, excuse me. Did I put in 745 before? Yes. Oh, that was a mistake. Should have been 645. So let's go to 645. But even at 745, there were discount points. Now let's look at 645 because that makes a difference. Oops. Let's open it up. Oh, slide down. So 100 points less goes from whatever that number was, 1,100 and something. Now it's up to 2,254. Now, if a person's got a 745 credit score doing an FHA loan with a minimum down payment, and they're going to have roughly 7,500 or 8,000 in closing costs, how many people are going to have an extra 2,254 laying around they can just write the check for? Not very many. But discount points, unfortunately, are part of the equation today. Now, I'm going to take this down one more level because you sometimes have people who say, but I think I can qualify. I think I can qualify. You know, my credit score is only 618, but I think I can qualify. So let's just take a look at what happens if the credit score goes down to 618. And these are, honestly, I'm just giving you live situations that I deal with all the time. And people want to know and they don't understand, and I get it. It's hard to figure out. Oh, ouch. So the score drops down to 618. Look what happens with my discount points. And there is no rate above it. Now, how often can this change? Jeff, I know you know the answer.
By the day.
By the day. Actually, this can change in midday. Now, I probably went a couple of years without interest rates changing in midday. But in the last probably year and a half, interest rates have changed midday more frequently than they had in the previous almost decade. Because interest rates just have a tendency to fluctuate more now because of all the uncertainty of what's going on. Sometimes they get a little bit better, most of the time they get a little bit worse. So generally speaking, once a day, but can happen midday. All right? So when a lender tells you that they don't have any choice, it's $6,550, guess what? They're not trying to mislead you. They're not trying to mislead their borrower. That's what the actual cost is. Something that came up on the conversation that you and I and Cuggin had, we were chatting about it, and they said, well, Greg, how do I trust this? Well, the lender cannot upsell that. It is against the law. Went into effect on April 1st of 2011. The lender cannot upsell this here. If this cost is $6,550, I cannot tell the customer $7,000 and charge it to them. If I do something like that, I can get kicked out of the business and fined and go to jail. So we can't change it. Now I can discount it. If it's $6,550, I can say it's $5,000 and eat $1,550 in this example, but I cannot upsell it. It's very important, all right? So now, will every lender's chart look like this? And the answer to that is absolutely not. They'll vary. Some lenders, this cost could be higher, some it could be lower. I don't want to get into a whole discussion on why that is. It has to do with how much money they want to make. That's the bottom line, okay? And if you're wondering what does that mean, most of the time if you're doing a listing, you want that listing to come in at what? How much of a percent that's going to be paid in commissions? 6, okay. But does it always come in at 6? No. Are there some real estate agents and companies out there that never charge 6? Yeah. They're called discounters. Some come in and they say, we'll just do a flat fee. Are they going to get the same service that Worrell is going to give them? Heck no. All right. Mortgage industry is no different. All right. There'll be some people that'll discount all this kind of stuff and they're going to try to tell you that everything's going to be the same. Well, it's not going to be the same. So.
If you change the reserve
No. The only time it's going to have an impact is on jumbo and investor products. And that's what I'm going to show you next, our investors, because we're getting a lot of inquiries on investors. Lots and lots of inquiries on investors. By the way, I don't want to go past my time, but if we change all this to conforming, you would see that at a 781 credit score, there's actually a par rate, but it's at 7.375. So think about that. 781 credit score, and I get a par rate at 7.375. I looked it up this morning. So, but I want to show you investors, because investors are the ones that get shocked. So let's make some changes. So I am going to change this to a $320,000 loan and a $400,000 property, because minimum down payment is 20%. Now I'm going to increase my cash reserves up to 20 months because it has to be at least 12. Otherwise, it'll give me an error. DTI, I'm going to take it down to 39 because I typically can't go over 43 on investment anyway. Got to change it. It's not primary. It's investment property. Let's leave everything. Oh, this is not a first-time home buyer. So now, change this to conforming. Let's change this to 7.5. What did I use for a, oh yeah, let's don't go 618, that'll never fly. Let's go to 750 on my FICO. This is a pretty realistic investor situation. Oops. All right, let's go slide down so you can see it. So, 7.5, look at this cost. Look at, I can go up as high as 7.625, but look at the cost to the investor on this situation. I had a call on Saturday, no, yeah, it was Saturday, with an investor. And they were shocked when I sent them the information. I told them to beware. But they said, Greg, that just doesn't make any sense. And I said, I actually took a screenshot of their scenario and sent it to them. Said, this is just what it is. I said, I'll help you out a little bit. I'll discount it a little bit. But I mean, you're not going to, I mean, $12,000 almost to get a 7.625 rate. There is no par rate. This is a 750 credit score with 20% down. Now, you can improve it. So let's just watch this. 12,464. 12,464. Let's go in and revise this. Let's change this to 300. Leave everything else the same. Now we've got 25% down. $25 down. Look at how much this changed. It cut it in half. So in a case like this, the borrower, the way we look at this is say, okay, borrower, I know you only want to put as little down as possible, but if you put an extra 5% down in this situation, where in this situation that would be $25,000 more, you will immediately save, just in discount points, $6,000. How many of us would be willing to spend an extra $25,000 to save $6,000 immediately? Obviously. So when you're, and again, now you're talking generally pretty savvy people who are buying investment property. I have to tell them, you're going to get a rate someplace up here and it's going to cost you $5,000, $6,000, $7,000, $8,000. I mean, you know, They're not happy. And if they're not happy with what I'm telling them, guess who they call next? Exactly. What is Greg saying? Is that really the case? That's why I'm going over this with you. Because whether it's an investor, whether it's a strong borrower with 781 credit scores, whether it's FHA, and FHA says, but they're supposed to be helping us buy homes. Yes, but it still costs money. So this is all aimed at giving you some ammunition so that you can actually say to them, hey, we looked at your scenarios online. Now, in a year, we'll probably do another one of these, and you're going to find this is not at all the case. You're going to find that 7.625, you might, probably at 7%, instead of costing $8,000, probably get an $8,000 credit. All right, last thing, and then I'm going to break. One of the things where Al Cuggan and myself were discussing was something called, as Cuggan put it, free refinances. I call them no-cost refinances. Has anybody heard of these advertisements that are saying buy now and get a free refinance later or get a no-cost refinance later? Anybody see any of those crazy ads that are on TV or on the radio? Because that's what's going on. They're advertising it. There is nothing free. The attorney still expects to be paid. The state of Georgia, if you get a loan, you have to pay $3 a thousand for the intangible tax. That's not an option. Somebody's got to pay that. Where do you think that comes from? It's coming from here. What happens when they say no cost, they're raising the interest rate and using what we call a servicing release premium, which there is no servicing release premium on this scenarios, but there will be in a year. And they're using that premium to pay some or all of the costs associated with getting a loan. And for years and years and years and years, that's exactly how we did it. But when rates started going up so fast, now they're not doing it. And again, they're not doing it. Why? Because from a business perspective, they know everybody's going to refinance out of these loans in about 9 to 15 months from now. All right. Any questions? All right. Thank you.